How's it going, everybody? My name is Antonio, and I am on the barbecue today on September 14 with Tyron Breytenbach, the Senior Vice President of Aris Mining, who's the operator of two mines in Colombia. Who's on here with us today, though, is your financial advisor. This is going to be just a conversation, and it's going to be a conversation that is not going to include any recommendations to buy or sell anything. It's just a casual talk between two people who you've never met and you don't have a reason to use as financial advisors, obviously. So for as far as you as a listener or viewer are concerned, this is going to be a conversation that's general and in-person in nature, as well as a conversation that will include a lot of forward-looking statements. Those are basically, well, educated guesses about the future, about events that may or may not happen in the future. Please take a minute to pause the video and read the full warning that is on your screen right now, because the mineral exploration, development, and mining industry is among the highest risk industries out there. So if you care about money, you don't like losing it, you're gonna have to do more research by visiting the company's website and analyzing its official filings on setter.com, as well as, of course, consult a professional investment advisor before taking your own decisions in the end. That all said, Aris is a $450 million market cap company, which is divided over about 137 million shares outstanding. And that makes this a $3.30 stock, give or take, at the time of recording. There are about 46.5 million warrants with 7.2 million options out there. And that means that there are about 195 million fully diluted shares, 6% of which is owned by insiders and 32% is owned by various institutions. The stock trades on the TSX main board under the ticker symbol ARIS, where an average of about 140,000 shares trade a day, with a 52-week high of $4.92 and a 52-week low of $2.69. And actually, since today, the stock also trades on the New York Stock Exchange, American, that is, under the ticker symbol ARMN. Aris Mining currently, as I said, owns two producing mines in Colombia and has two development projects, one of which in Colombia as well. The other one is in Guyana. They also have a smaller project in Canada. In total, the company has 15.5 million ounces in the measured and indicated category and 7.8 million ounces in the inferred category, with about 2/3 of that being in Colombia, in the Colombian assets. More specifically, in northern Colombia, Aris operates the Segovia mine, where over 6 million ounces have been extracted over the last 100 years, 1.5 million ounces of which were produced over the last 11 years at an average grade of 13.6 grams per ton. And about 19,500 ounces were produced this August alone by Aris themselves at an average grade of 11.7 grams per ton. And the company targets a 195 to 210,000 ounces of production at this project this year, at a cost of what's been looking Q1, Q2 at around $1,200 per ounce, give or take. Company is also trying to expand the known resources and replace the mine reserves here as well at the Segovia mine, as well as obviously find new deposits outside of the current resource. And they're spending $17 million for 17 drill rigs this year. Those drill rigs are supposed to drill 84,000 meters, the majority of which has actually already been completed. So results have been rolling in, but there are still some assays pending. A little bit to the south of that mine, and so 80 kilometers south of the Medellin city of Colombia, Aris operates the Marmato mine, where a recent PFS showed the possibility to produce up to 162,000 ounces of gold per year. With a 20-year mine life and a 37% post-tax IRR at $1,700 gold that was done, with an all-in sustaining cost of about $1,000 an ounce, so lower than the previous mine. And the guided production for this year is between 20 and 30,000 ounces of gold, for a total guided production of 220 to 240,000 ounces between the two producing mines for this year. Next to the two producing mines, Aris also operates and owns 20% of the Soto Norte project, which is considered one of the world's largest undeveloped underground gold projects, with an indicated resources of up to 8.5 million ounces of gold, obviously, and 3.6 million ounces of inferred gold, that, according to a 2021 feasibility study, can be extracted for an all-in sustaining cost of but $471 per ounce, which is interesting, obviously, because it's very low. Company has the option to buy an additional 30%, which would then bring them to an ownership of 50% of the project for an additional $300 million. Next to that, Aris also owns the Toraparo project in Guyana, where a 2023 resource estimate added 5.4 million ounces of gold in the measured and indicated category and 1.2 million ounces to the inferred category of the NI 43-101. And then last but not least, as I said, Aris also has a project in Canada. It's called the Juby project. They own 100% of it, so it's their project. There's about a million and a half ounces of gold in the inferred category. There are 700,000 ounces of gold in the measured and indicated category, but it doesn't seem like they're doing much there right now, so I'm hoping to figure out what's happening there. But generally, the main goal, as far as I understand it, for this company to become an Americas, but specifically Latin America-focused gold producer, and they're targeting 400,000 ounces of gold per year by 2026. I'm also hoping to figure out what's happening with Colombia, with the government, with inflation, as well as their plan for financing some of the capex here and stuff like that. But for that to happen, I'm going to have to shut up already and welcome Tyron. Sir, thank you for being here.
Thanks for having us. And I know this segment is called CEO Barbecue, so I'll start off by saying I'm not the CEO. I'm Senior Vice President, Capital Markets. Our CEO, Neil Woodyer, is a lot more well-known than myself, but he's in Colombia at the moment. So I'm pleased to be here with your audience, and thank you for doing your research. I think that was a very comprehensive preamble and kind of sets the stage to talk about our company here this afternoon.
Pleasure is all mine, and I'm very happy to speak to you. You're not the CEO, I get that, but I still think it's going to make for a good overview and a good interview because you're a mining analyst and you're just a person who I've also wanted to speak for a while now. I know Neil is obviously very well known in the sector, but among people who try to figure out and learn how to do their research, you're well known yourself as well. So you got to give yourself credit for that. But again, I tried giving you a fair overview, but it'd be even more fair if you add on to that. So let's maybe start sort of with three things that you like about your company and three things that you like to improve on in the future to make it more fair.
Okay, I like that, and thank you for setting the stage. So I think anyone who's listening to your preamble will immediately take away that we've got a lot of resources. Okay, and one of the big reasons I joined Aris is that we've got the raw material. So we've got over 20 million ounces of inventory in all categories, and you're not taking geologic risk. Exploration is difficult. We have a lot of exploration upside, but the reality is I don't even need to talk about it because we're undervalued relative to our production and our existing inventory. So I think something that's unique about Aris is you don't need to take that drill bit risk. And I think that's important for a generalist looking at the gold space. Something else that sets us apart, I think, is that we're insulated from the market. I think gold is building a crazy base here at the low 1900s. It's been consolidating for what feels like a year now. And we're heading to a point where the Fed is probably going to pause. A lot of my former clients who are smarter about the macro than me think that's the point where gold starts to move. But I can tell you, having worked at an investment bank, is when gold breaks through 2,000, 2,500, whatever the number is, a lot of these developers are going to hit you in the face with a big equity financing. We aren't going to do that. And the reason we're not going to do that is we have 214 million US in cash. We have another 260 million coming in from our streaming agreements with Silver Wheaton. So at Toraparo and Marmato, our growth projects, we produce a lot of silver. So we've pre-sold that silver by way of a streaming agreement. And that's going to help us fund all of our assets without issuing a single share. And then our mines make a lot of money. So Segovia is tracking to around 100 million US in free cash flow. So we're really insulated from the volatility of the equity market while we're waiting for that gold window. I think that is something, again, that generals should take comfort from. Another way we're insulated is our management team. So our chair, Ian Telfer, he started Wheaton as a $20 million shell. At its peak, it had a $50 billion market cap. Peter Maroney is on our board. He founded Yamana from a single asset. Obviously, Neil Woodyer, he was the genesis behind Endeavour Mining, which is now the largest gold company in Africa, one of the largest companies by market cap in the world. Frank Justra was also involved in some of those deals, and he's a big shareholder and a strategic advisor. So what that does is it shows that we're not reinventing the wheel. Okay. We know how to build mines. We have access to the technical experts that it takes to define resources, build mines, raise capital, and find new deals. So I think that really insulates us. And then the third element of the story that I'm really excited about is the growth. Okay, so We recently got a permit for Marmato. It's a pretty big deal. I don't think we've seen an asset like that permitted in Colombia since Buritica, which was probably about 3 years ago. And now with that permit in hand, with our funding in hand, we can just go and build Marmato. And that takes our production from sort of 230 to 400,000 ounces a year. And it's my view that gold stocks are growth stocks. I don't think, your value proposition can be that you're staying flat. You have to grow. I think that's the quote unquote sexiest, segment of the market, are these growing mid-tier producers. And I think we've got a fantastic de-risked growth profile. And what's great about Marmato is we're expanding an asset we're already on the ground. So we know what a unit of labor costs. We know what a unit of power costs. We understand what access is like. We understand what power reliability is like. We understand, what it's going to take to get a ton of cement to site. So I think it's no mine build is low risk, but I think Marmato is on the lower risk spectrum because we're already on the ground. It is a bulk tonnage continuous ore body, and it's just low capex to start with. Like the capex number is $280 million US. That's easily overfunded by our current financial resources. So I think those are the three elements where we stand out. And remind me, the second half of your question was three challenges or three concerns, so to speak.
Yeah, pretty much.
Yeah, so I'd say like everyone else, we're dealing with cost inflation. Okay, our big risk there is Marmato. That's where we're building. That's where we're spending the capital. But I think the fact that we're on the ground mitigates that somewhat. We've also done two feasibility studies, or pre-feasibility studies rather. We refreshed the last pre-feas in September of last year. So this is not a 3-year-old number. Like it's a pretty decent, relevant number. So even if we see some inflation, I think it limits how much of a negative surprise that could be. Something else that's working for us is the currency. So the Colombian peso has not done well versus the US dollar. And unlike West Africa, where a lot of your contractors are being paid in euros or US dollars, like we actually can pay a significant cost of our expenses in the local currency. One of the guys at site told me it's like over 40%, right? So that current currency hedge mitigates capex blowout a little bit. Fuel is semi-controlled in Colombia by the governments. That kind of helps us on the cost escalation front as well. So I'd say capital inflation, obviously that's a big risk. I think every geography on the planet, when you're a single asset company, has risk. So currently all of our production is in Colombia, and as you mentioned, Colombia is something investors will highlight as a potential risk. They had an election last year where President Petro came to power. He's definitely more left-leaning than his predecessors. But I'm really comforted by the fact that he's part of his big flagship fiscal policy, right? And we've seen an increase in taxes on oil and gas companies. We've seen an increase in taxes on high net worth earners. There were some minor modifications to the gold mining companies. Most notably, we can't deduct royalty expenses from our tax bill anymore. So our taxes have gone up a little bit, but the big fear was some talk of an export tax or a windfall tax for gold. Now that never came to fruition, and that policy is behind us. So I think no country is risk-free, especially when 100% of your production comes from one geography. But I think if there were any sort of landmark policies that we're going to see, those have now been put in place. And then obviously we just permitted Marmato. I think that caught a lot of the market by surprise. And something that makes Colombia unique is the informal mining sector. Okay, so countries like Peru, I mean, everyone knows it's been a mining powerhouse for a century, but Colombia has a very long history in the mining space. It's just been informal, artisanal, and a stat I heard recently, and I can't vouch for its veracity, but we understand that about 80% of the gold exported from Colombia is currently mined illegally. Okay, and when you're mining gold illegally, you're not paying taxes, you're not following environmental policies, you're probably not following labor standards. And it's generally not something that's desirable. And if you see some of Petro's public remarks, like he's anti this cowboy illegal mining industry. Okay, but to formalize this industry, what you need is capital, you need expertise, and most importantly, you need a processing facility. So I think the thing that is most misunderstood about Aris, and I didn't fully understand this until I joined the company, went to site a couple of times, is how we work with the artisanal. So Segovia, which is our flagship producer, it'll do close to 200,000 ounces this year. 40% of the production there are sourced from partners. So this is something we have to give GCM credit for. So about 5 years ago, or something like that, they signed their first artisanal small miner agreement. And these agreements are similar in that we're essentially buying ore from the artisanals. Sometimes they're mining our concessions, sometimes they're mining their own concessions. And we pay them based on a formula of grade, tonnage, and the gold price. And often these guys, are mining in smaller, tighter areas, and they're bringing 40 gram per ton material to the mill, which we can blend with our sort of 10 or 11 gram head grade. And part of this agreement is that these guys get paid directly to a Colombian bank, which means they're now in the banking system, which means they can now pay taxes and report their income. We can help them with grade control. We can help them manage explosives and have control over the explosives chain. And most importantly, we're getting 96% recovery at a modern SAG mill, whereas these guys are probably mostly just using gravity recovery with a little bit of mercury, and the tailings often get dumped into the drainage system. So some of our sampling in the regional area has shown the level of the contaminants go way, way down since Aris has signed these partnerships. And so GCM started with one agreement, I'm going to say 5 years ago. I think that's the correct timing. As of today, we have about 68 agreements. That covers 3,000 people who are now taxpayers, have a bank account. And artisanal mining can be a dirty word. I think when people hear that word, they imagine a underage child in Africa. And, this is the status quo in a lot of Colombia. There's a long history and tradition of small-scale mining, and we've been able to successfully work with these guys as partners. They're making more money. Our shareholders are benefiting. And I think it's a template that is being recognized by the government. And I would flag that we got our permit at Marmato shortly after signing our very first artisanal small mining agreement at Marmato, right? So we are determined to be good citizens. It has its challenges for sure, but we are now the largest gold mining company in Colombia, and I think we're well positioned to work with the government on some of these issues. So I'd say Colombia would be the second challenge. And again, it's just because we have so much exposure. We actually love the geology. We actually like being in Colombia. At some point, we should de-risk as we build our business. But for now, we're very pleased to be there. I'd say the third challenge would be just executing, right? This company was created very recently through the merger of Aris Mining and GCM. It was a good deal because it put together a huge resource base of development projects and a consistent cash flow producer, okay? But now we need to make sure that Segovia remains consistent. We didn't have a great Q1. The stock got hammered. You rightly pointed out that August was a record month for us. We produced 19,000 ounces, so the mine's humming again. It looks like we've dealt with a lot of the issues. One of the big issues was an explosive shortage that affected the whole country. So if we execute at Segovia, start to build trust with the analysts, shareholders reporting consistent earnings, and then build Marmato without it being late, without capex overruns, I think that's what gets the stock to move. That's our single biggest catalyst. That's on us to just put our heads down and execute. So I'd say those are the three biggest challenges.
That's a very comprehensive overview. This is a new thing that I do. I didn't used to start that way, but I think I might do it a lot more because it gives you an opportunity to talk about the positives, but also to address some of the challenges out there. But so, okay, I get it. Cost inflation, you're figuring out how to deal with that. Colombia, you say you don't mind Colombia. Operational risk, you're saying that you're figuring out how to deal with that. But that's maybe not necessarily what the market is seeing, because the stock has been in a wild ride this year so far, from almost $5, as I said, to about down to almost 280. And of course, the markets are far from perfect right now, so there's an element of that to it. But you seem to be lagging some of the other producers as well. So I'm just thinking, what is this market weakness, or is it to be attributed to one of the challenges that you walked me through here that you think the market doesn't understand?
Yeah, so the most common pushbacks are Colombia. And it's not that Colombia is bad or Colombia is negative or they don't want to invest in Colombia. It's very simply, how do you discount Colombia? Okay. And I think price matters, right? Yes, Canada is safer, but what's the average grade in Canada these days? Like 0.9 grams a gram, right? What's the average value per ounce? Okay. And then I look at companies like Lundin Gold, who I have so much admiration for, right? Going into Ecuador, being a good corporate citizen, hitting it out the park, having an ore body that deserves to be built. Like, you don't want to open up a new industry in a new country with a mediocre ore body. Like FDN is a fantastic ore body, and I believe on consensus they're trading at 1.2 times NAV. So they're trading at a premium to Canada and the US. K92 is another example. I mean, PNG has its issues, but you have to look at the country as not a homogeneous blob. Like there's different parts of the country have different risks. So at Segovia and Marmato, we're in historical mining friendly belts. We've got a reputation. We're integrated in the community. So the risk profile is going to increase as we go to Soto Norte, right? For sure it is. But that is also an ore body, as you said, that could produce at sub $500 an ounce. So, you show me another 12 million ounce resource with sub $500 an ounce cost. Like it's worth taking on the challenge. And so in our deck, we've got some valuation multiples. And I, refer to Richard Gray at Cormac. I used to work with him at Cormac. So, I just picked his numbers because I know how he does his models. And I think he's a fairly conservative guy. We're sort of at 2 times cash flow and 0.2 times NAV, okay? Which is not even on the same page as the rest of the universe. So even if we trade at a discount, like let's say the stock was at $4 or $5 today, I think we're still at 0.4 times NAV, which I think is arguably, still too conservative for Colombia. So I understand there's risk, specifically single country risk, but I think that's being mispriced right now. And I think the fact that we missed in Q1 and Q2 didn't help. The fact that we didn't have the best liquidity because management owns a lot of stock. We've got a few chunky institutional shareholders. That didn't help. And something else that's hurt us recently is the ETF, the GDXJ, is obviously a big buyer of equities in this market, right? Where your long-only gold funds aren't having a ton of inflows, the marginal buyer is the ETF. And when Yamana got sold, they changed their methodology for how they make up the index. And I won't bore you with the details. You can go and research it online. But the net effect was they had to sell a couple million Aris shares. That happened in August, quiet summer. Guys were watching the tape, and that took us down to below $3. Since then, operations have started to improve. August was a great month. Stock's been up sort of 15-16% the last couple of sessions on a cumulative basis, and we've listed on the NYSE, and we think that'll address the liquidity issue, right? Because when you go and see some of these big institutions, they can't own less than, say, 15, 20, $30 million shares. And so to get that position, you'd often have to move the stock, 15, 20%. So I do think that liquidity will help. And look, we've come off 2 not so great quarters. I think if we can string together a few solid quarters in a row, and I think credit to our operations team, that merger only completed in September. There were some staffing changes. There were some process changes. We've only owned this asset for 2 or 3 quarters now, and I think they're starting to turn it around. So I think it's that execution that's going to drive the valuation change.
The de-risking comment earlier was also interesting to me when he said that at some point you're going to have to de-risk by diversifying your operations. Is that something you've already talked about, or something that you can tell me about as to where you might de-risk to?
Yeah, so if you look at what Telfer did with Goldcorp or Wheaton, what Woodyear did with Endeavor, very acquisitive, sort of a deal a year type of track record. We have so much resource base, we don't need another development stage project. We need more production. If you look at our board, they've been very successful in the Americas, and so I think that's our time zone, right? North and South America. We're looking for production, and I would say our perfect asset is something that maybe has a bit of hair, needs a bit of an operations team upgrade. Maybe you need some capital because we have capital, we have the bandwidth to turn a mediocre asset into a very special asset. But we're looking at sizable production. So I'd say 150,000 ounces up producing is kind of our sweet spot right now. And again, like, we're not in a rush at these levels, these share price levels, but our board has tentacles all over the space. And I think that was a big reason I joined Aris. Is when I joined Aris, they were a developer. We're now a producer, building our second mine. We want to be a million ounce a year producer. And to do that, you need a pipeline of assets. And I think when Mr. Telfer calls some of these senior companies and talks about assets in the portfolio, they're going to pick up the phone. Whereas it's sometimes tougher for an upstart single asset producer, to work these contacts. They might not have the right Rolodex, and that Rolodex is really important in our business. So we see a lot of product.
And earlier you mentioned that you think it's undervalued, as in you're not getting much value for the exploration upside or any of the other operations. How do you even value a company like this? I mean, you used to be, as I mentioned, a mining analyst. How do I value it like a product? I mean, I don't know. Where do I even start? Is it single producer? And it's just so many things to it.
That's a great question. And what's interesting about Aris is the valuation is so low. You can pick your metric, and we're going to be at the bottom end of the group, whichever one you pick. We have 7 analysts who cover us. I'd say the average target's around $7 a share. A lot of them discount Toroparu, Soto Norte. Those assets are further down the road in terms of when they get built. Soto Norte has permitting risk for sure. So some of them give us zero value for Soto Norte. Others will give us $20 an ounce at Toroparu. But I think the most BS free metric is just cash flow. Okay, and we're trading at 2 times cash flow at Segovia. And Segovia has been around for 100 years, right? It's generating a lot of free cash flow. We've replaced reserves every year for 5 years now. It looks like we're going to easily do that again based on our recent exploration results. I know it's got a shorter reserve life, but it's had that same reserve life almost perpetually, right? It's one of these ore bodies where you got a big resource, small reserve, and it's just a lot of drilling dollars, and it's formulaic to turn resources into reserves. And you don't want to drill out a 10-year reserve; it'll cost you $100 million. So we would rather have a rolling reserve life. Although this year I think we'll actually grow it a little bit. So I would say, a fairly bulletproof way to value the company, or not bulletproof because nothing's bulletproof, and there's so much subjectivity in any valuation, would be to value Segovia on cash flow. Let's look at Marmato on a NAV basis and maybe give it 0.5 times NAV, right? Which I think is a very fair multiple for something that's funded and permitted. Give us 0.2 times NAV for Toroparu, and let's have Soto Norte be option value. And I think we would still screen inexpensively. So I think a lot of it has to do with we're a young company. Our first 2 quarters post-merger were rocky. And so the market just needs to see the operation settle.
Okay. And then, well, I guess you would also sort of use an EV instead of a price metric here, because we've mostly been talking about the price. You had $215 million in cash at the end of last quarter. Where is that right now?
Absolutely. So you have to look at the EV for sure. Our EV is a lot bigger than our market cap right now. So we have $220 million in cash. I think that'll grow this quarter. We have about $370 million in debt. So I think our EV right now is around 600 Canadian versus a market cap of say 450. So net debt I think is around 150-ish. Please check our website to make sure those numbers are accurate. And then on the warrants, right? Like we do have a fair number of warrants outstanding, but I want to point out that the bulk of those strike at 550. Okay. And they would bring in over 210 million Canadian in cash. So that could be a financing mechanism for project number 3 after we built Marmato. Maybe we could use that to pay down the debt. And then the other thing I'll point out on the balance sheet financial metric side is that when Marmato is up and running and Segovia and Marmato are running at the same time, at this gold price, we should be doing $300 million a year in EBITDA, right? So we'll have sort of 1 times debt to EBITDA ratio, which is pretty healthy for a gold company. There has been some talk of buying our debt back early. It is trading at a discount, but it's 6.8% money, right? Like that's pretty inexpensive for a gold mining company. So we're not in a rush to do that, and priority is just building Marmato, getting that up and running, and then we'll have to reevaluate the mix of debt and equity.
But Marmato is going to cost you 280 based on the studies. So I mean, if there's, you mentioned cost inflation, if there's inflation to that, even if it's 10%, you're going above $300 million. Do you think your free cash flow is going to be sufficient to finance that, or are you going to be going for maybe more debt?
Well, we got $220 US in cash right now. Okay. Wheaton Precious will advance us 120 based on the existing streaming agreement, right? And so they released that based on permitting and construction milestones. So 220 plus 120, you've now almost covered capex. Plus, you've got the annual free cash flow, which last year was, I believe, around 100 million US. So based on our numbers, Marmato is substantially overfunded.
Okay. And then permits wise and all that, you don't have to spend any more money on it since you've gotten the environmental permit this summer, right?
Correct. And, permitting is a pretty low cost activity. We are still permitting and engineering at Soto Norte. We've got a budget, I believe, of around 50 million to actually get that to a permit decision. But the great thing about that is we have a right to go up to 50% of that asset, a predetermined right at a predetermined price. But right now we're only a 20% owner. But Neil is the CEO of the joint venture company. So we get to lead the permitting, lead the engineering, but we're only carrying 20% of the cost. So it's a pretty good deal for Aris and our shareholders.
Okay, so but that's an interesting thing that I wanted to ask. So I mean, you're absolutely still planning on going for the full 50%.
Look, the NAV on that asset at today's gold price, would make that 50% look like a steal. In our mind, there's no point spending a lot of brain power on that because it's a permitting story. Let's get it permitted, right? Let's design the right project and the right permit application to get it permitted. But I would argue that this asset with no royalty, no stream, it would be one of the biggest, lowest cost mines in the world. I don't think it's going to be a challenge financing that remaining 30%. Something else I'd add is that our joint venture partner, Mubadala, I believe they manage 180 billion. And they've introduced us to some of their banking relationships on the lender side. Plus, there's a massive amount of copper. I believe the resource on that deposit is sort of 800,000 pounds of copper. There's a lot of byproduct metal there to stream. There's the royalty angle. But yeah, I think based on what we know today, we would fall over ourselves to increase our interest to 50%.
Okay, fair enough. And then burn rate, what's that? You've lowered it actually a little bit since the acquisition, of course. Not a little bit, but what is it? Is it sitting at around 10, or where is it sitting this year?
For Soto Norte?
No, just your corporate burn rate, G&A.
Well, yeah, okay. So G&A, I don't know the exact number. It's gone down since we merged with GCM. There was a reduction there in some synergies. I think we mentioned it in the press release and the circular. I believe we saw savings of about $6 million a year annualized. The other big burn last year was at Toroparu. Okay, I believe GCM spent $60 million last year. We're going to spend a fraction of that. So at Toroparu, we came in and we've got a very specific way of how we like to do things. So we relooked at the resource. We took a much more conservative approach. We like to build the assets we own and understand them and take off a lot of the fluff. And so we took the resource down from sort of 10 million ounces in all categories to sort of 7. But we have a lot more confidence in the current resource. And our efforts there are sort of limited to scoping, engineering. We're not doing any drilling. So we've really slowed down the burn there. And I'd be surprised if we go over $50 million for the whole year there. But as a corporation, we expect our cash position to grow. So the big payments this year were in Q1. We had a $50 million payment for Soto Norte, right? It was from to complete the ownership of the first 20%. And in Colombia, your taxes accrue all year, but the big bill is paid in Q2. So we had a big tax bill in Q2. So Q3 and Q4 are when we expect to start to grow the cash balance again.
Right. But then this year, there's no real need to go back to the market. If you're going to be coming back to the market, it's going to be for Soto Norte if and when you get the permit. Exactly.
The only time we would conceivably come back to the market is, okay, we build Marmato. Now we need to refinance our debt. We probably, turn it into a cleaner structure because right now we got the bonds that have a coupon of 6.875%, 3 million bonds that GCM took out to build Toro Peru. We've still got those. It's a great piece of paper. And then there's a gold note for around $70 million, right? One's due in 26, others due in 27. Marmato should be built in 2026. Company-wide EBITDA should be 300 million. So that's when we'll look to refinance. Then at that point, we're going to have to look at Toro Peru and decide, do we do some equity? Do we do some more debt? Can we build it from cash flow? But step one is scoping the project, because when we redid the resource, it made the old PA obsolete. So the prior PA had a two-phased approach. It looked at open pit and underground, going after the gold-rich resource and the copper-rich resource. We're looking at all alternatives. It might be a bigger mine, it might be a smaller mine. My own view is I think the open pit only makes more sense than the open pit plus underground. My own view is that staging it probably doesn't make a ton of sense. I think you want to build it the right size from day one. These are just personal opinions, but that's the first step. So we're looking to update the market next year on the scope and the plan and the design for Toro Peru, which is going to inform funding after that.
Right, but the debt thing is interesting to me because of the sheer amount of money that you paid in interest last year. What is it, $20 million or something along those lines?
Yeah. I mean, look, we inherited a gold note that pays interest based on a reference price. Reference price is $1,400 an ounce, and so if gold's at $1,900 and you got a reference price of $1,400, there are some big coupon payments you need to make. We would not have done that financing facility, but when GCM did, or not even GCM, when Caldas Gold did that, the markets were brutal, and that was the financing that was available. But look, it's time limited. We'll get through it, and it doesn't impede our plans to go out and build Marmato right now. Okay,
well, fair point. Is there a point in the future where, when you're looking to raise money, you think about selling Juby? I mean, it to me, it doesn't look like it fits the overall strategy right now. Again, maybe a personal assumption, but how do you feel about selling that asset?
Yeah, look, it's a great asset. I mean, 2 million ounces plus in the Abitibi. That's always going to have value. It's a great postal code. There are some substantial producers nearby, so there's a lot of logical homes for that ore. But you're right. We have our eye on Colombia and Guyana right now. And that would be a distraction. So I would flag that as non-core. Now, we're not going to give it away. It's a good ore body, and it's going to come down to the market, right? But I think you could put that on the list of non-core.
Okay. So, but if you would be selling that wouldn't be right now, again, because you just don't necessarily need the money right now, and you can afford maybe to wait for the market to not be as soft.
That is exactly correct. I mean, if someone drives a truck of money to our office, we'd take that very seriously. But we're not running a sales process or anything like that. It's more time and technical capacity. But I often think about Mayfair Gold next door, which had a similar genesis story, has a pretty good management team, and I look at that market cap, and I would certainly say the street doesn't give us that value for Juby. A lot of investors don't even know we own it. So I think it does make sense to monetize that at some point.
Okay. Fair enough. And then the idea is to just, because the long-term idea is to become self-sustaining, focus on South America, and not need any capital from the outside. But then do you think you'll eventually go back to a dividend model, or is the idea to still, get acquired by a major at one point? Do you want to become a major? What's sort of the long-term goal?
That's a great question. And, that's going to be left up to the board, but I can give you some really good sound bites. So the first thing we did when we merged with GCM is cut the dividend, right? You can't pay a dividend and grow. I was an analyst for 10 plus years covering stocks, and I never had a client call me and say, hey, go pick me up this stock because it's got a juicy 2% dividend. I think if you want to, especially in a world where a high interest savings account pays you 5.5%, right? Do people really care about a 2% dividend on a gold company? I think it shows discipline, and it might be something we do at some point, right? When we've stabilized and become self-sufficient. The great thing is we all own our stock, right? I mean, I own a lot of Aris stock. I think about our stock every day. Management and the board own 6% of the company. So we are going to think like shareholders, right? So we're very protective of our denominator. We really don't want to dilute. but we want to grow. We think the best way to create value here is growing. When the market pays us for the growth, then maybe we start to think about a dividend. And in terms of like the ultimate end game being taken out, again, this is above my pay grade, but Neil's on the record saying becomes a little bit less fun for him when it's a million ounce a year producer, right? Then it becomes a different company. Okay, you're then in the business of replacing rather than growing. It also then becomes a bit more of a bureaucracy, I think. Requires a different culture. I'm not saying one's better or worse than the other. It definitely requires a different personality. So I think we'd like to take this to 1 million ounces, get the market to value it correctly, and if at that time there came an opportunity to exit, I would say our board has historically gone that route. I mean, that's what Peter did at Guyana. That's what Neil did at Endeavor. So I think that is a reasonable guess, but I can't say for sure. But step one is growing and having our stock reflect our asset base.
Well, but you cannot get to that 1 million ounces with the assets they have right now. So that would mean buying or finding more. What do you think the focus is in terms of, strategically, the focus of the company? Is it sort of an 80-20 of finding our own, increasing our own reserves? Or do you think you're going to be focusing more on figuring out who to buy?
That's a great question. So before we talk about, buying versus building and exploring, I want to talk about our mine life. Okay. So Segovia, as mentioned, has been around 100 years. We're mining, I believe, 4 of 30 known veins. There's no shortage of gold in the property. It's an amazing system. It's a strange operation, right? The town and the mine are really integrated. It's unique. And I love taking analysts to site because you just see what a good ore body it is. I mean, if you look at our grade over the last 4 years, it's been so stable. It's just such a good ore body. Marmato, you referenced a 20-year mine life. That's a reserve life. So 3 million ounces of reserves. We have 8 million ounces in all categories. Okay. So if you look at the resource, you can squint and see a 40-year mine life. And so a lot of companies, especially single asset companies, the day they build the first mine, they're already sweating, how do I buy my second mine, right? Whereas we can stay at 400 for a long time, I believe, which gives us the time to go and grow. And then in terms of our, internal growth, Toro Peru had a PEA showing 225,000 ounces a year. That theoretically takes us to 600. Half of Soto Norte would be another 200,000. That gets us to 800,000 ounces. So yeah, we can't get to 1 million on our current ore body, but if all the stars align, we could get to 800. Now this is like not backed by 43-101. This is a lot of arm waving by me. So please do read our technical disclosure and our forward-looking statements. But you asked the question, so I'm just trying to give context, right? I think 400 is our on paper guidance. Plus Toro Peru plus Soto Norte is blue sky to 800. But yes, we need to look externally as well. And then if I had the chance to talk about the exploration upside at some of our projects, it's just incredible. I mean, our neighbor at Marmato Collective is putting out some of the best holes in the space, right? And that is a big intrusive belt. It's a big intrusive system, and Marmato is wide open. So I think we're going to add a lot of ounces there. It's just when you're trading at $12 an ounce or wherever we're at today, it doesn't make a ton of sense to go and do some more drilling, right? Like the market wants to see permit, bull, de-risk. But I think there's a lot of exploration upside. But at the same time, we're also looking externally for sure.
And the timeline was 2026 for the 400,000. The timeline that you're targeting, of course, and this is also an example of forward-looking statements. What would the 1 million ounce be like? Will it go quicker from 400 to 1 million than you went from nothing to 400?
Yeah, I think it's easier to do deals and climb the property ladder when you have more heft and you're a bigger producer, right? So I think a 400,000 ounce a year producer with a clean balance sheet that's trading in line with peers can do bigger deals than where Aris was a year ago, where we were a developer trying to build Marmato and it was our only asset. So definitely we can look at a different snack bracket of companies for sure. And if you go look at the Endeavor path, that's what Neil did, right? He started with a small producer, They optimized that mine, ran it well, were able to borrow some money against that asset and then go and build the business and sort of leverage into better and better quality assets.
Right. Right. And with your own assets, you do have a couple of options there that you could also target to do that. One of those you mentioned, Segovia, quite a lot of drilling. I mean, this is 84,000 meters of drilling is for any company is a lot of drilling. I don't hear much talk about that at all because you're a producer. I guess not many people focus on the exploration thing, but 84,000 meters, 17 drill rigs, $17 million of drilling. It's just a lot of drilling. What are you focusing on specifically, or is it known structures, looking for new zones, a little bit of both? What are you looking for?
That's a great question. So the first thing I'll say is this is a narrow vein mine. The vein is typically like a meter wide, right? So you're mining two meters. It dilutes down to sort of 14 grams, but often these intercepts are like 60 centimeters, but at 100 grams, right? It's that kind of ore body. And so the reason the drilling is so high is often you'll drill a 100-meter hole, but you're looking for a 1 meter wide zone, right? So it's a lot of drilling to get there, especially when you're doing it from surface. So what we're really trying to do is put in the underground infrastructure so you can do fan drilling. So you're drilling a 10 or 20-meter hole instead of a 200-meter hole because you really only want that intersection. So as we develop underground, we can do the conversion drilling a lot more easy. It just becomes a grid pattern, and you go bang, 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 because it's just formulaic. As you increase the density, you convert resources to reserves. So our exploration campaign this year, I forget the exact mix. So there's a margin of error of what I'm going to say, but I believe it's about 50% resource to reserve conversion. Let's say another 30% targeting near mine targets, trying to find something new near to existing infrastructure. And then the remainder, true grassroots, trying to find a new vein. And that press release we put out in July identified 3 or 4 areas that aren't in our mine plan, but are like 20 meters away from mine infrastructure. So at the end of the year, we'll update the reserves. And I mean, we would hope to continue our pattern of replacing, but this year, I think we would actually like to grow it a little bit. But so replace the mine life and then also grow it a little bit.
Right. Okay. Fair point. And then, well, I'm just going off of where is the growth going to come from. So that's Segovia. And then you have Soto Norte. Of course, we talked a little bit about that. Maybe you can talk to me a little bit more about that, about what's happening with the permit. And this is going to get us into talking about the Colombian government, because we talked a little bit about it, but I just like to know a little bit more with Petro there. He's been out there, he's not the perfect president you're going to want as a mining company, to say the least. So maybe we can talk more about that as well.
Yeah, so on the growth, I mean, something else about Segovia is don't forget these artisanal partnerships. These are powerful partnerships, right? And these are very productive miners. And so we recently, not recently, late last year, we expanded the mill from 1,500 tons a day to 2,000 tons a day, okay? Something that becomes very apparent when you go to site is the front end of the plant. So a typical gold plant is comminution, so like big jaw crusher, grinding circuit, so ball mill, sag mill, and then the cyanidation, doré side of the plant, like filter press, etc. So the front and back of the plant are currently rated for 3,000 tons a day. The mill is the bottleneck at 2,000 tons a day. So there are things we can do that are very, low capex, high return to turn this into a 2,500 ton per day plant, 3,000 ton per day plant. And if we have the reserves to support that, we could grow production. If we don't have the reserves to support it, and this is something we're looking at internally, we could look at the artisanal model, expanding that artisanal model. So that's step one. And then moving on to Soto Norte. Okay, so we're a joint venture partner. There's a feasibility study dated 2021. This feasibility study outlined a big underground mine. So the idea there is to build a tunnel that would have a 6-kilometer long drift from sort of a valley area into the deposit. And the reason the deposit, is challenging to permit, or more challenging to permit than somewhere like Segovia, is that it's close to the Paramo. So the Paramo is defined by elevation. It's higher up in the mountains, and it's a water catchment area for the country. So it's very important that the water basin is protected. So mining is banned in the Paramo. There were previously a few Canadian listed companies that had assets in there and were trying to move them forward, but that's never going to happen. So we're not in the Paramo, okay? And I think a lot of people assume we are, right? Because the Paramo, it's been redefined a couple of times. So we're not in the Paramo. That's a very important statement. But we're close by. So we've designed a very low impact, low footprint mine. So we're going to come in from 7 kilometers away. We're going to mine underground. We're going to put the crusher underground. So there'll be almost no surface infrastructure above the resource itself. And then we're going to produce a concentrate. So no cyanide, no mercury, and we'll have a dry stack tailings facility. So no risk of a tailings failure. So very, very low impact way to build a mine. It's higher on the capex side, but the project can carry it because the gold equivalent grade of the reserve is 9 grams. So think about 9 grams times 7,000 tons a day. Most 9-gram mines are 1,000 tons a day, maybe 1,500 tons a day, maybe 2,000 tons a day. That'd be a really good mine. And usually 7,000 ton per day underground deposits are like a gram or less, right? And that's why it's so low cost. It's big, it's bulky, and there's a lot of byproducts. There's 0.2% copper, I think over an ounce of silver, and 6 grams gold. And what's interesting is, that's one way to build a mine. But if you increase the cutoff grade, it could still be a super profitable smaller mine. But right now we're focusing on making sure we understand all of the environmental considerations. We are communicating with the locals as well as the federal government, explaining what we're doing, explaining our plan, getting input on our plan, adjusting our plan, and then we'll use that to file a new permit, hopefully later this year. And the only data point I can give you is Buritica, which was another big underground mine, was permitted in 10 months. Okay. So those are some data points there. Something else I'll say is the artisanal issues in Colombia are very topical. And at Soto Norte, there are active artisanals. And we saw the activity when we went to site in December with the analysts and some investors. And these artisanals are operating illegally for the most part. They're not paying taxes. They're not using a tailing system. So the tailings just gets dumped down the valley into the river. Like, that's a problem. And so something we can offer that other companies can't is we can work with the artisanals right now, move their ore to Segovia. We could build a starter plant and tailings facility to kind of contain the effluent, right? So this is where you have to get creative and you have to be a good corporate citizen. And I think it's challenging, but as the largest gold mining company in Colombia with the best ASM program, I think we've got a really good shot. So that's sort of our focus. And I don't know Petro. I mean, I can see his public statements like anyone else, and I think he's very upset with the illegal mining. I think he wants to transition the economy to a green, non-carbon economy. But I also see, currency that's weakening, inflation that's a problem, and like every government, they're trying to balance the budget. So there's the idealistic dream, and then there's the way to get there. And maybe the way to get there is to start by focusing on small, contained ASM partnership type operations. And I also believe that most people are logical, and if the alternative is these veins being mined illegally right now, and impacting the environment, I think we offer a solution that kind of has a really good mix of economic benefits, social benefits, and we've done it at Segovia. Like, it's one thing to come in and say you're going to do this. Like, we can take people to Segovia, and so it gives us a bit of credibility. So that's our plan right now. And for what it's worth, I mean, Neil, our CEO, is in Colombia 2 weeks a month, right? He's very hands-on, and we changed our board a little bit with the GCM merger. We brought on Monica de Graef, so she's on our board, and she was the former justice minister of Colombia, so really heavily respected. And she actually worked with Petro. I believe she was the head of the utility company in Bogota when Petro was the mayor of Bogota. So we've got a dialogue there. We've got a recognized, credible person on our board. We've got a former minister of mines on our board. I believe we employ 3,000 Colombians. So I do believe we're in an interesting position to take advantage of this opportunity. Because the flip side to Colombia is the geology is spectacular. Like it's the same mountain belt as Colombia, as Ecuador, as the countries to the south. It's just seen a fraction of Western exploration, and we're seeing Collective next door, put out some punchy drill results, and I think they've got sort of a $400 million market cap pre-resource, drill story. So when people say, well, you should trade at 0.2 times NAV because you're in Colombia, that's a strong counterpoint, right? I think Colombia requires, extra work. It does come with some risk, and it's our job to eliminate that risk and diversify that risk away. But you can't just throw the baby out with the bathwater, in my opinion.
How's the so I get that on the government. Governments change too, right? I mean, and quite often and quite quickly in Latin America too. But what doesn't necessarily change is the way the locals perceive you. And so, I mean, if you don't have the local support, oftentimes you're not moving forward as quickly or smoothly as you would like. So how's that with you? I remember there was something about the water not too long ago. So how's the local support with you?
Yeah, so at Segovia, you have to come to site. I hope you get a chance to sometime. There's a school there, okay? I believe Aris helped fund the build of the school. We were coming back from the mine shaft, and all the kids left with their report card and had the Aris logo. And if your parents work at the mine, you can go to school for free. And I believe, depending on how good your grades are, even if your parents don't work at the mine, there's scholarships available. We reinvest in the community in a very transparent way. So I believe last year our community infrastructure budget was $12 million US, right? That's a big chunk of change. And we have a board that's made up of members of the community. From Aris, we've got Monica, the former justice minister. She sits on the board and helps allocate those funds, make sure there's no funny business. And they see it. They see it in roads. They see it in parks. They see it in sports fields. Something else we did last year was we built a polymetallic plant, so we could take the zinc, lead, and some other metals out of our tailings. So the tailings is now a very valuable fill. So you're in this jungle environment where you don't have a lot of full material, and so we're providing that for like sports fields and building materials. So they're seeing the benefits to the community as well as like training. And at Soto Norte, we've got an office in the local towns. It's got a model of what we want to do, what it would look like, jobs that we would train for. Because what's interesting is that project, I believe, doesn't anticipate an outside workforce. There'll be some outside workers initially to do the training, but we hope to train the local community and give them a higher skill job without impacting their traditions. There will be some change for sure. I mean, associated with good economic growth. And we've invested as well. So the community around Soto Norte, we recently, us and our partner Mubadala, invested, I believe, $2 million into the church. And if you go to these small towns in Latin America, the church is always the epicenter of the little town square. It's a gathering place. It's so important to the community. And if you go and visit this church, like it's gleaming. They're very proud. We helped them renovate it. They're looking after it. It looks fantastic. So yeah, we intend to be a good corporate citizen. And you're right, governments do change, but we have to respect the government that's in power. We want to follow their rules, and I believe we have a logical plan, and we're going to present it to whoever's in charge.
All right. Well, and then you have quite a different situation in Guyana, where you have the Torparo project, but that's later down the road. Maybe we can talk a little bit more about it. We mentioned it a few times, but as far as I understand, the timeline focus right now is continue executing production, growing the production, then go to Marmato, and then go into Guyana. And is that happening? That's happening by 2026 as well, right?
So we have no guidance there. Basically, our only guidance is we need to figure out what Torparo is, because we inherited a PA and a resource. We redid the resource, and it looked quite different. It was smaller. The gold was in a slightly different, geometry. So step one is what should the project look like? Should it be smaller? Should it be bigger? What's the right scope? And so we're in the engineering phase right now, and we really can't make, guidance decisions on timing, capex, or anything like that until we know what the project looks like. What I will say about Guyana is obviously, unless you've been living in a cave, they've had one of the greatest, oil discoveries like in the history of the world. I believe more barrels of reserves per capita than Saudi Arabia. So it is white hot. It's booming. And this offshore oil production doesn't employ a lot of people. So it's great for the state coffers, but it doesn't train and employ people. And so I've heard and seen presentations given by government officials that they want to move some of that wealth in the interior, right, to the mining wealth, like lithium, gold, copper. And so we're seeing more infrastructure, which means hydroelectric infrastructure, roads, dams, etc. And so Guyana should be an easier place to operate by the time we build that than it is today. And Guyana, like Colombia, is wildly prospective. I know it sounds cheesy, but I am a geologist, and I am going to say it. It's the same geology as West Africa, separated by hundreds of millions of years of continental drift, and it's seen a fraction of the exploration of West Africa. And think about, 15 years ago when SEMAFO first went to Burkina Faso, no one had heard of the country. Now I believe they have 10 gold mines, right? And they're higher grade than the established countries. And some of the best exploration stories, G2, Reunion, like it's all Guyana. So it's a great place to be. They speak English, British common law. So it could be a pretty interesting place for us to continue to build our business.
Yes. West Africa is an interesting place too. And you're right. There's sort of because I'm interested in another story that is on the West African Shield, and the whole thesis is that it resembles the Carajas province, because that's where the two continents split about 100 million years ago when it was Gondwana. So it's definitely an interesting place. I think I'm getting the timeline. That's what I was getting through. You want to go to 1 million ounce. How are you getting there? This is the timeline. This is what we know till 2026. One other thing that you obviously have to pay attention to is well, the most important thing is margin in the end, right? How much money do you get to keep per ounce of those million ounces? And when you announced your 2023 objectives at the beginning of this year, obviously with the closing of last year, you thought that you could produce at about 1050, so $1,050 to $1,150 per ounce. But again, energy inflation, specifically in fuel and electricity, as you said, in Colombia, turning out to be so having had some operational challenges there, and it's turning out to be above 1200. Are you going to be getting that back under it when you get the operational stuff more under control, or do you expect it to remain there?
Yeah, so at Segovia, our updated cost guidance is 1125 to 1175. And I would say, low 1200s, that's pretty good in our business, right? At a $1,900 gold price, that's pretty good margin. I would say it's, off the top of my head, lowest quartile. Something that we've wrapped our heads around, and we've changed the way we report our costs at Segovia, is the partnership model. Okay, so when 40% of your ore comes from a partner, and that partner is paid based on the gold price going up means you have higher costs. So there's a portion of Segovia that has a fixed cost, like a really good margin, like let's say 50% margin or whatever it is. But if the gold price goes up, you don't capture all of that margin because you have to pay your partners more, right? And that's because our artisanals are real partners, and we need them to be exposed to the gold price. Now, it's not all of our production; it's around 40%, but that was a factor. That was a factor as well. And then Marmato, I really struggled the first 2 quarters. One of the big issues were explosives, specifically the detonator caps. It was a countrywide shortage. They don't have a huge mining industry, and they didn't have enough of a stockpile, and basically we weren't able to get detonators on time, and so the mine lagged. And so that kind of impacted our company-wide costs. But I mean, you saw what we did in August at the mine. It looks like September's looking pretty good. So we're very confident that we're going to make our guidance, and our guidance at Segovia is sub 1175, which I think is just spectacular in this market. The mine's making good money at these gold prices.
Right, and that's all-in sustaining cost is oftentimes a confusing term to me, because you don't have the financial costs in there, G&A is not in there, and so if you have a financial cost 20, and if we round up G&A to 10, that's how much would that add to 200,000?
Well, good on you for actually doing the work, right? And so no gold company wants to disadvantage themselves to another gold company. And all-in sustaining cost is a metric released by WGC. But what's not in there for us, and every company is different, and this is where the analysts, I think, are most useful, is how do all the different companies play the games. But so for us, if we're exploring for new resources, not converting resources, that'll be outside our all-in sustaining cost, right? Because that's exploration. CapEx to build Marmato, right? That's not a sustaining cost. Like that is new growth. It's associated with new production and new revenue. So the number at Segovia includes everything at site, all G&A at site, all conversion exploration. The only thing outside of that would be corporate G&A. I think we're at $6 million a year. And maybe a third of our exploration budget would be pure exploration that wouldn't be included in that cost. But our finance group does a really good job of breaking it up. And if any investors want to dig into this, please reach out. Like we'll happily do a forensic analysis with you. But I think our financials and MD&A has a lot of disclosure on this front.
Right. Okay. Well, again, I think I've been forcing myself to keep my eyes on the ball and trying to focus on the margin in the end. Like how much money is every ounce actually going to make for the company? That's where I'm coming from with this. But no, I think I've been through most of the stuff that I wanted to ask you. Yeah, we went through the risks. We talked about quite a lot. Is there something that you came here hoping to talk about, but I'm failing to bring up?
No, you've been very thorough. Thank you very much. All I would say is I like asymmetric opportunities. Okay, we're priced at the lower end of the group. A left-wing president has been elected and has made his big policy changes. So I think the negative news is out there. There was a lot of skepticism around us getting Marmato permits, which we now have. So I think we're starting to chip away at the major pushbacks, right? And it's not like we're up on a stick. So I think there's some downside protection. We don't need capital. We own our own stock. So a lot of downside protection. And, if like me, you think gold's going to put on a big move here, I think there's going to be a window where we capture that margin. And you're right, it is all about margin, right? It's shocking to think about what the all-in sustaining cost is today versus 2011, the last cycle. So sure, gold's at 1900, but are the margins better than they were in 2011? Probably not. So we probably need gold to go higher before the sector catches a bit. But you also want to be careful that you're investing in something that when that window opens, they're not going to dilute you. They're not going to layer on cost inflation. They're actually going to capture that margin. And I think Aris does a good job of providing a vehicle to invest in that addresses all those issues, doesn't take exploration risk. You don't need to be a geologist to invest in our company. We own our own stock. I think the average management share price is around $4.50 a share. So if you buy the stock today, you're making money before we do. Those are Canadian numbers. And we just got a US listing, right? So we have a bigger audience to kind of communicate with. So appreciate the time, and it's up to us now to put our head down and deliver. But I think you've been very thorough, way more thorough than I'm used to. So I appreciate you going the long form route.
Thank you for the kind feedback, and I appreciate you investing so much time in me. I'm going to be following along, and maybe in a couple of months' time we can update people on it and myself and see how this is going. But yes, thank you so much for sitting down with me today.
Okay, thank you.